Hello and welcome. I'm Jeffrey Mishlove. Today we'll be exploring empirical research using news-based indicators. My guest is Peter Hafez, who is the director of Quantitative Research for the data provider RavenPack. He has an extensive background both in the financial world and as a researcher with Sir John Cass University and Business School in London. Welcome, Peter. Peter, I get the impression from our conversation that you are exposed to a lot of information on a day-to-day basis about how companies and other financial instruments are responding to the news. And at the same time, you have conducted some formal research studies to try and capture large, long-term effects. I'm under the impression that probably you have in your head a lot of, I'm going to call it for the moment, folklore, ideas that seem pretty likely to you, but that have yet to be nailed down in terms of an empirical research study. So for the moment, let's focus on the actual empirical findings, the ones that you have studied extensively and published, with the caveat that there's probably a lot more background that you could offer.
Yeah, definitely. So typically, when we look at our research, we kind of work within a given framework, and kind of to have everything fit together, and kind of start to build almost a coherent theory. And we typically work with a three-tier framework. So we say that there is market level sentiment, there is sentiment on related entities. And then you have, and here, let's say for companies or for equities, a sector is a good proxy for relatedness, but there could also be other types of relatedness. So co-referencing in the news, for instance. And then finally, you have entity-specific sentiment or company-specific sentiment if we talk about more in the equity space. So, and you kind of see that sentiment feeds through the system. It both goes upstream and downstream, right? So individual company sentiment you can aggregate that up into can you say so you basically go bottom up and create a market level sentiment indicator based on that. And but you can obviously also go from more of the macro side and create a sentiment indicator just based on macro news. So you have, can you say, two proxies there of market level sentiment. We have also, as part of our research, so we've spent quite a bit of time, can you say, creating these type of indicators, aggregating sentiment across companies, for instance, in the U.S. to create a U.S. sentiment indicator, or countries across, let's say, the rest of the world to create a world ex-U.S. indicator, and see if we can figure out when the U.S. will outperform the rest of the world, or when it will be the world outperform the U.S. But you can obviously also take some of these indicators that we've built, and I'm going to go into greater detail with some of the research, but you can also take some of, can you say, these aggregated market or sector level indicators and relate that back to individual stocks. So figuring out what companies are currently most responsive to market level sentiment. And we've done, can you say, a research piece there that has gotten quite a good momentum in the industry. Because it, can you say, links into some of the more traditional thinking of beta. So how responsive are individual stocks to market return to the market? So that's kind of the traditional beta from the CAPM equation. We have kind of introduced a similar concept when it comes to news and said, let's call it news beta, and say, how responsive are individual stocks to market level sentiment or changes in market level sentiment? And what we found there was that you could divide a universe of companies into, can you say, negative news beta stocks and positive news beta stocks. A negative news beta stock is a company that, can you say, has moved against market sentiment over the past time period. We looked over a year. Positive sentiment stocks are stocks that have moved with sentiment over the past year. And when we looked at companies and divided them into these two different groups, and also evaluated it across, can you say, some of the more traditional factors that you can look at. Obviously, you need to look at it more as, does it bring value to what I already know about a given stock, given its size, given, let's say, a momentum, or its traditional beta. Does news or news sentiment bring additional value? And what we found in our study was that yes, it did. We typically find that news beta holds very low correlation to these other traditional factors, and that's as a quant what you're really looking for, some orthogonal data set. Because there is the potential of adding value to your prediction model. If they were 100% correlated, that wouldn't be any can you say additional or new information in your indicator. So that's obviously the first step, and we found that to be for news beta to hold very low correlation. The other thing which was interesting was that we found that those stocks that tended to be most responsive to traditional factors also seemed most responsive to market level sentiment. But you could be a high beta stock, for instance, but be either a positive news beta stock or a negative news beta stock. So it seemed to add an additional dimension to it, a new way of, can you say, splitting up the universe.
This is overall market sentiment, not particular sentiment with regard to that firm.
No, this is when we created a US market sentiment indicator. So we are trying to relate back, can you say, market level sentiment and to individual stocks. And one of the reasons for why that is attractive is that you may not have news on every single company every single day, but you can definitely create a market level sentiment indicator. And you can then say, okay, if I haven't got any company specific news, you may expect that other type or sentiment at a different level will be driving you. So we are basically saying that let's look at a market sentiment as being the driver. That's probably a pretty good hypothesis to put there, that you are probably driven by market level sentiment when you have no specific sentiment about you. So that was basically what we did and came up with this news beta approach. And we found can you say a number of very, very interesting things here. First of all, we found that negative news beta stocks typically outperform positive beta stocks all the time. So you kind of, and in terms of can you say economic interpretation, you could see that those stocks that haven't been, can you say, so when markets are going up, for instance, those stocks that hadn't been impacted by this bullishness in sentiment seem to go through a catch-up period, and therefore they will outperform over the following time period.
And may I ask you, what was the time frame for this study?
We looked at, can you say, in terms of investment horizon or backtesting period?
The backtesting period.
Yeah, we basically considered 2000 through 2011, I believe. So it's something relatively recent. We basically found that so we had, can you say, both the can you say the financial crisis in there, and can you say the about the time when the dot-com bubble kind of burst. So it's a quite interesting period to test, and kind of what we found was, as I mentioned, that negative news beta stocks typically outperform positive news beta stocks all the time, and as I mentioned also, so when you are in a bullish sentiment environment, you start to you see that those stocks that hadn't moved with this bullishness seem to go through a catch-up period. But when you start to move into a bearish sentiment environment, those stocks that haven't been impacted by this bearishness actually continue outperforming, and therefore you end up being long negative news beta stocks all the time. We did find two distinct periods where the relationship seemed to reverse. So negative news beta stocks underperforming positive news beta stocks. It was two periods of about 5 months, and can you say more from a casual observation, because it's very difficult really to pinpoint this and show strong statistical significance given that we only had 2 periods. But from a casual observation point of view, we could see that the negative spreads kind of clustered around market low. So a couple of months before the market low after the dot-com bubble bursting, and a couple of months before the bottom of the market in 2009. You kind of saw that the relationship's shifting around, and that lasted for about 5 months. So you saw it 2 or 3 months after the bottom of the market that positive news beta stocks started to outperform, and then it went back into the relationship again. That negative news beta stocks started to outperform once more, and we were talking about investment horizons here of 6 to 12 months. So it was a very, can you say, low turnover signal with very long horizons. So the claim that markets are efficient, I'm not so sure about that.